All right, so we are celebrating Investor Week or World Investor Week on the Money Show, and today we'll be focusing on one of the most crucial aspects, risk and returns. And to get this concept clear and to help you navigate your investment strategies around this, I have with me Feroze Azeez, Deputy CEO, Anand Rathi Wealth. Feroze, good evening. Welcome to the show. Not that we haven't spoken about this concept earlier, but then let's just totally focus on this and talk in detail about risk and return and how can one actually work their investments around this. So understanding risk and return as a concept in a particular investment instrument that's related to equity, how can you decode it?
Yes, good evening, Kavita. Of course, this is a topic we've discussed numerous times, given your passion for personal finance. I'm sure we've done several shows of that. But I think one important point when it comes to return is return has to be measured in an equity product relative to some index. That's very important. Most of us don't measure enough. That's the point I'm making. We invest in equity mutual funds for years, several transactions, but we don't know what is the exact rupee value benefit of our equity investments. So the point I'm trying to make is measure what is measurable. Returns relative to a specific index have to be measured. Second, people stay in property, they don't measure their compounded return on the property or the house they've bought and lived in for 10, 15 years. So return measurement is being something which investors have not done enough. They manage their own direct equity portfolio, they don't know their own alpha over Nifty, but they'll keep judging fund managers on their alpha. But on their own direct equity, they will never have the alpha. Now, for example, I met a client. He said that I don't believe in any other fund manager, so I manage my own money. So I asked him, what is the extra return you generated over Nifty by doing 1,700 transactions? He has generated several crores lesser than Nifty for himself. So return needs measurement. Measurement has to be relative if it is equity. That's on the return side. Risk is beyond market risk. Markets price risk. Money can go up and down every day. That's what is the risk which people always think of. But there are several other risks. To measure market risk, there are two very popular variables which we should all compute for our portfolio if we are serious about managing the money which we spend years to accumulate.
Feroze, let's also just focus on types of risks which are involved around most of the investment instruments, or when we talk about various type of investment instrument, not only just equity, what kind of risk are we actually thinking of?
Kavita, there are 5 important risks. Of course, the chronological order of importance. The first one is the risk of price moving, which we also call market risk. That's the first risk. The second risk is the inflation risk. Depletion of value of money with time. That's the inflation risk. The third risk is the credit risk. You lend money to someone or a corporate and that person is not capable to repay it. That's credit risk. The fourth is currency risk. Because you stay in India, largely 90-95% of your money will be in Indian rupee. If you have global objectives, then currency depreciation can eat away into your money. That's the fourth risk, which is called the currency risk. Lastly is the liquidity risk, where if I wish to sell something which I own, what is the price I'll have to let go of? That's the liquidity risk. These are the 5 risks which we should consider.
So, Feroze, now after understanding the kind of risk, it's also important as to how you can mitigate and how what kind of a strategy maybe you might want to adopt as per your portfolio planning, because it's not just equity investment that we are talking about. We are talking about a financial portfolio where you might want to diversify it across asset classes, right? So, how can you mitigate your risk by adopting a diversification strategy, and what kind of risk might just erupt if you fail to do so?
Yes, Kavita. So before we have to mitigate, yes, there are diversifications, the right method to mitigate your market risk largely and even credit risk. But what are the measures which are available for all these 5 risks which we just touched upon? It's good to make a note as a viewer and do some secondary homework because there'll be some reading needed because risk is very abstract. Most people understand risk only in English, high, medium, low, most individual investors. But bank treasuries and corporate treasuries measure risk numerically. So let me tell what are the measures which a person can read about if they want to manage these five risks. One, which is the market risk, has two very popular measures, which is standard deviation and beta. These are two great measures to measure the risk of one's portfolio and how much does the price move. So standard deviation is a measure of absolute risk. Beta is a measure of relative risk. What do I mean by that, Kavita? If the beta of a portfolio is 1, that means that the risk is equal to Nifty, for example, if that's what you're comparing yourself with. 1 beta means equal to market risk. 1.5 beta means 50% more than the market risk. Similarly, 0.5 beta means half the market risk. So 1 means equal, anything more than 1 is more than market risk, less than 1 is less than market risk. So beta is a great risk measure for you to check what is your portfolio's risk. Most individual investors don't have this number for their overall portfolio. To begin with, you should try and read up on this, and a simple Excel sheet can help you compute this for yourself. That's on the market risk side. Credit risk can be measured using ratings or another score called Z-score. Use that. Liquidity risk, there is a measure called impact cost, which is available for stocks on NSE, are available for mutual funds. With your distributor, he can calculate for you impact cost. I think these three measures, these three important, you should at least know the measures: standard deviation, beta, Z-score, and impact cost. And
So
yeah, Kavita, now I can come back to your question of how to mitigate.
Right. So Feroze, yeah, please go on. Please go on.
Kavita, like you rightly pointed out, where diversification, optimal amount of diversification can reduce your risk. A recent study of 1,000 portfolios which we did, which were not with Anand Rathi Wealth, but they were with somebody else as distributors, we realized that larger number of schemes actually reduce the risk of underperformance with Nifty. There are about 65 portfolios out of the 1,000 we analyzed. They have done better than the Anand Rathi model portfolio. The rest of the 935 people have done worse off than the Anand Rathi model portfolio. The 65 people had an average 27 schemes in their portfolio. So diversification, like you rightly pointed out, can not just mitigate the risk of equity market, but also the risk of underperforming the benchmark, is what this study of 1,000 portfolios of thousands of crores cumulative threw up. So that's the best way to diversify in equity and across asset classes. Like gold is a great diversification tool because it does not correlate itself to equity. So diversify across asset classes, across products inside the same asset like equity. Diversification becomes a very, very strong tool to reduce your risks and in turn beta.
So, one very specific question, Feroze. We are talking about investment strategies, and here typically we are talking about having longer term goals. Okay, is the kind of risk that we are talking about, or the risk reward ratio or risk return ratio, is different for a long term investment strategy, or for a short term quick buck strategy that someone might want to go for?
Kavita, this is such a pertinent question. The time frame will decide which is the risk you have to be more worried about. If you have a shorter span of time, the risk which is something which should scare you should be the market risk. If you have a longer term, the risk which should scare you is the inflation risk. If you have 10 years, let's assume you're speaking of a retirement goal, inflation takes precedence over all other risks. Now I met somebody in Chennai. He said, I put 5 crores in a fixed deposit and that's my retirement cost. And I'm going to retire after 10 years. The 5 crore amount at the rate of 7% pre-tax was reaching to only 9 crores after 10 years at his tax slab. 9 crores. But the inflation of his lifestyle was 12%, which means to lead the same lifestyle, he will need 15 crores of maturity. But this person will be left with only 9 crores. So he's thinking that my 5 crores is safe I'm getting 9 crores, but the value of money will deplete at the rate of his inflation, which is 12%, and he will need 15 crores to just break even. So longer the period, inflation risk becomes the most important risk. Shorter the period, market risk is become the most important risk to mitigate. So shorter periods can't have equity, longer periods can't not have equity. So if this fundamental principle of risk mitigation is understood, I think 60% of the job for the viewer is done.
One thing I think it is very important to highlight the risk involved in not investing at all.
Yes, Kavita. Kavita, did I hear you right? The risk of not investing at all.
Right, right, Feroze, right.
Yes, Kavita. Again, a superb question. And this is where 80% of Indians fall. They are great savers, but bad investors. The RBI data says we have saved humongous 29 lakh crores in financial assets have been saved in the last financial year. 29 lakh crores. Let this number sink in. This is Indian household savings, including real estate, which number is still to be released by RBI, which we might cross 45, 50 crore, 50 lakh crores. So we are great savers as a group of Indians. We are very bad investors. So not investing is a risk which we all face. If you don't invest, the small monies which come to your bank account, or at least left after all the expenses which we are today tempted to do, including weekend expenditures, if you're left with some money and you're letting it laze around, you're missing out on two things. One is, of course, the return potential of 12-14%. The other is the learning possibility. If a person has 2,000 rupees to invest a month, and if he's investing for 3 years, even 2,000, he or she goes up the learning curve. When he or she then has 20,000 a month, the person is not beginning to learn with 20,000. He has learned to swim with 2,000 and not with 20,000. So the cost of a mistake is very small when your amounts are small. So I would be very happy if a 25-year-old starts investing 1,000 rupees, learns his principles by the age of 30, when he has more money to save, he has gone through the learning curve. And I think that's a very softer aspect, not appreciated enough, because each of us will do our mistakes. The sooner you do the mistakes on smaller the amount, the fruitful your financial life is going to be. So please listen to Kavita and don't go with this risk of not investing at all.
All right, so no investment is actually risk-free. You just have to figure out what's the risk profile that you have and how you can align all of that with your financial goals. A very important lesson that you learned from Feroze today. And Feroze, with that, thank you so much for being on the show today and helping our viewers with this very important topic. Thank you.